This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 138 was recorded a day early this week on Wednesday, October 24th, 2018. I'm Eric Townsend. Professor Daniel Lacalle joins me as this week's feature interview guest. Daniel says synchronized growth has always been a false narrative. We'll discuss everything from equity markets to fixed income to gold to Argentina and China. Be sure to stay tuned after the feature interview when Patrick and I will welcome Marin Katusa to our postgame segment to discuss the gold breakout and also Mohammed bin Salman, potentially, according to some rumors at least, at risk of being sacked by the royal family of Saudi Arabia. We'll discuss that situation as it pertains to the Khashoggi murder. We'll also have an update on our live event plans in Vancouver on January 19th.
And I'm Patrick Ceresna. Now, Eric, the S&P 500, what a day to actually record a day early, right? We have S&P 500 breaking those key levels below 2,700, and that selling just accelerated. I mean, we saw a print as into the close very close to 2,650 on the downside, and the sellings just seems to be just gaining momentum. Obviously, I have an opinion on that, but what's your thinking here on the S&P?
Patrick, I think that today's tape action is super bearish, and the reason I say that is yesterday, Tuesday, we saw really what looked like it might have been the beginning of a reversal pattern, a reversal candle on the daily chart. The bulls were trying to do that, show up at 2,700 by the bottom and get the market moving higher, and it failed flat on its face. The bears took control today and sold to new, considerably lower lows. As you say, almost 50 S&P points to the downside just in the last few minutes of trading. So I think this is pretty darn bearish. Now, as far as, does that mean it's time to short here? No, it's too late in this particular move to be shorting. I would think that probably that you'd be covering here, waiting for a bounce if you're a short-term trader, looking for another opportunity to short a higher number. But it looks to me like probably something fairly significant is upon us. Does that mean that it's the big one, or is this more of just that tremor that comes the year before, as we had in 2007? There was a lot of shakeup in markets, but it didn't really get ugly until a year later in 2008. In general, though, Patrick, I've said for years on this program, as long as we've been doing this program, at some point the piper has to be paid. Our equity markets have been propped up for 10 years now by central bank largesse, and I don't think that there's a free lunch. Someday the piper has to be paid. Is that upon us yet? I'm guessing probably not quite yet, but we're getting closer, and this certainly looks like it has all the ingredients of developing into something more. We'll have to see whether or not we get a rally into year-end and what happens, but I would be very surprised if we get to new all-time highs at this point. And the real question on my mind is, how big of a downside event is this going to be? Is it over yet, or is there still more to go? And I won't be surprised if there's more to go. What are you doing from a big picture trading standpoint with your members? I know you've been short this, making money for your members, which is great. Are you covering yet, or are you holding out for lower prices?
Well, we actually covered the S&P straddled short anyway into the first wave of selling, and we basically called this turn and we're looking to go short, but we basically left our members on their own in terms of how they position into it. But really at this stage, just an hour ago, I basically started my process of covering in my personal shorts, largely because I'm on a plane to San Francisco tomorrow morning and I don't know if I'll be able to watch it. One thing that I wanted to kind of reference was the chart that we shared with our listeners last week, where we talked about all of those levels on the S&P 500 where the gamma acceleration can actually impact, and CTA levels where the selling can intensify. From a technical perspective, I'm looking for the supports to come in on the selling somewhere very close to where the lows came in during the February and April sell-off. So the sell-off could very well just wipe out the entire summer summer rally. But after that, I do think we're going to bounce. And the interesting part about that is that with us wiping out the entire summer rally in one fluid motion, if the next rally doesn't have any meat on the bone, it does really start to set up some more bearish stuff. I mean, I want to share some charts in the upcoming weeks during the post game where we can really kind of dissect what the different scenarios are and how past one market tops have developed and what that would translate to here. But let's save that for a future episode. With that said, let's move on to the dollar index. Now, we saw a key breakout above 96, and more importantly, it's coming on a breakdown of the euro below that 115 level. Now, we are recording on Wednesday, and tomorrow on Thursday, we have the ECB speaking, and obviously the central bank news could always be a trigger to, let's say, potentially start a reversal rally in the euro, but there is a technical breakout. We are definitively breaking that 96 handle. Do you think it's real? Can that dollar squeeze really get some momentum here in your mind?
Well, I feel very optimistic that we are headed higher. The thing is that if you go back and you look at the previous high from, I think it was the 15th of August, that number is still a little bit higher than where we topped out today. I'm looking at about 96.55 or so on my chart as to where the top was back in the middle of August. So that number needs to be taken out to really confirm the bull move is on. But if I look at the pattern in the chart just going back, say, since the beginning or middle of September, you know, we saw a low, we saw a high, we saw a higher low, and then we're moving to a higher high. The series of higher lows and higher highs is definitely in play. We just haven't taken out that mid-August level. Once we do, I really think we're headed pretty quickly from there to 97.50. Now, of course, as you say, ECB tomorrow morning, you know, anything coming out of Mario Draghi's mouth can cause markets to panic in one direction or the other. So it is certainly possible that we see at least a temporary pause, but I am still bullish on the dollar here. I think it can move much higher before this is over. And again, it's not because the U.S. economy is wonderfully great. It's more of the dollar squeeze scenario that we've talked about quite a bit on this program.
All right, well, let's move on to crude oil because my impression would be that we should be more aggressively selling with this kind of a break in the stock market. We are pretty weak. We're very close to the 66 level on crude oil, and that selling really has wiped out the entire August-September advance that we saw that tested the 76 handle on the upside. So we're a solid $10 off the high here. First of all, how did the inventory numbers come in? But in your mind, how is this going to play out? I mean, is this a major top developing in oil?
Well, let's start with inventory. Building 6.3 million barrels after 6 point something last week. It wasn't quite as big as the 10 million barrels that API had predicted. Cushing, Oklahoma, building 1.4 million barrels. So really big builds across the board and in Cushing. Now, finished products, on the other hand, drawing down substantially. Gasoline drawing down 4.8 million barrels. Distillates drawing down 2.2 million barrels. So pretty big distillate and gasoline drawdowns, almost balancing out the build in crude. But, you know, frankly, in the wake of hurricanes, you get some distortions and noisy data anyway. So I don't really read a whole lot of meaning into that part. What we are seeing, though, and I think is probably more important than inventory this week, is some of the other news that's come out. Khalid Al-Falih, the Saudi oil minister, basically reacting in the wake of the Khashoggi murder situation and all of the negative press that Saudi Arabia has come under, as well as the pressure from President Trump. What Al-Falih actually said this week on Tuesday was he said, look, you know, in reaction to President Trump's requests and so forth, what we're now doing is we are producing as much as we possibly can. Now, the way that I would interpret that statement, Patrick, and apparently the market disagrees with me, it's true. That means that they're increasing production, and that, in theory, would be a little bit bearish. But what is really is important is they're admitting something that I've been saying for years that I've been convinced of, and I think we've just gotten confirmation, which is Saudi spare capacity is a fantasy that doesn't really exist. So Al-Falih is saying they don't really have any spare capacity. They're pedaling as fast as they can already. They do not have the ability to increase their production any further than they already have. That's the way I interpret that statement. That ought to be bullish for prices, frankly. At least my interpretation is. It seems the market is taking it as a bearish message of we just increased or we changed our stance and we're now increasing our production in response to President Trump's pressure. I don't think that's the right way to interpret his actual statements. I would interpret it as we don't have any spare capacity, which is a bullish message. In any event, I think maybe the reason that we're seeing all of this selling anyway, even if there's at least some truth to my interpretation of Al-Fali's statement, is there was another article saying Mohammed bin Salman, the crown prince who is heir apparent to the throne in Saudi Arabia, could be sacrificed by the royal family as the scapegoat if they need one in order to deal with cleaning up the international PR debacle that has come out of this Khashoggi murder. And of course, they were very, very clear in denying any wrongdoing. And it turned out that, first they said it was just an accident. That's all that happened. And then it kind of turned out that actually they cut this man up into small pieces while he was still alive by accident. How do you do that by accident? So needless to say, they are really struggling to defend themselves in the court of public opinion. What I'd like to do is get Marin Katusa's view on this, because as you remember, not in the last time that we had Marin on the program, time before that, going back probably close to a year now, Marin had quite a bit to say about Mohammed bin Salman and his role. Marin has done quite a bit of research on this. So I'm really looking forward to getting his perspective on whether or not bin Salman is really at risk or if this is just talk. I will be very surprised if bin Salman goes down over this and loses his apparent heir to the throne status. But Marin knows more about it than I do, so let's get his perspective when we get to the postgame segment.
All right, well, let's move on to gold, because gold's been quite resilient through all of this. Like, the dollar's rising, the market is having a liquidity event, and gold has been pretty much pinned in this range. I mean, we're somewhere in that 1235 level at the time when we're recording, but almost no volatility. I would, at minimum, be expecting some volatility, whether higher or lower, but we really don't seem to be seeing much. What's your take on all of this?
Well, I'm watching gold very, very carefully, and the thing that is baffling to me, Patrick, is I have expected for a long time that gold would eventually turn around and would move up even as the dollar is moving up. And that's now what's happening. Dollar's moving up, gold's moving up. The thing is, the reason that I thought that that was eventually going to happen is I thought we'd get to, all-out crisis in the bond market where Treasury yields are going through the roof and everybody's panicking and the 10-year is no longer the safe haven asset that everybody wants it to be. And those investors that are able to, most of the institutional investors by mandate can't use gold as a safety trade, but those investors that can use gold as a safety trade start to do so instead of treasuries. The thing is, that's clearly not what's in play here, because what we have going on is Treasury yields finally coming back down and testing those critical levels that were previously resistance are now being tested as support. So it's not the scenario that I thought would get us to a synchronized move up in gold in unison with going up on the dollar at the same time. And is it really the case that we're in that safety trade mode? Now, I think back to what happened in 2007 and 2008. There was some strength in gold as we were approaching the crisis, those tremors before we got to the real crisis. Once the real crisis started and it was really game on for the stock market crash, gold sold off with equities, because even though logically it would seem like it should be a safety trade, it's that old adage that correlations go to one. Everybody's selling everything when you get into a real crisis situation. Gold sold off, bottomed, and then it really took off. So I think that we potentially have a setup. Now, we don't know if what we're seeing here is the beginning of another 2008-sized major move down in the stock market, but if that is what we're setting up for, and this strength is premonition or a tremor ahead of that, I worry about that scenario of gold selling off and maybe getting back down and testing 1,000 before it ultimately heads much higher. I am definitely long-term very, very bullish on gold, but despite this strength we've seen, the jury's still not out yet, in my mind, on whether we still have another move lower before it's over and we eventually get to a very big move higher. So I guess it depends on your time frame and perspective. If you don't want to miss it, maybe starting to average into gold here is a good idea. I'm still holding out. If we see a close above 1245, which is the number that Charlie McElligott gave us as to where the CTAs would systematically start to buy above that level, I may jump on there just from a momentum entry standpoint. But as far as the longer-term trade, I'm going to wait this out. I think we may still have a move lower before the ultimate really big move higher.
All right, well, let's move on to the 10-year Treasury yield, because after consolidating for pretty much about 2-3 weeks in that kind of 320, 325 being the upper boundary, we finally got a break today. We're down to about the 311 level on the 10-year yield. Seems like this market turmoil is starting to send yields lower in that potential safe haven trade. I mean, maybe I'm overreading just a one-day move, but what's your thinking here?
Well, I think we're right on a very critical level because remember, around 310, 312, that was the magic number everybody was watching as a resistance level just a few weeks ago. That means that it now becomes the level that we test as a support level. So it makes a lot of sense that after a major breakout, it's very common that you come back down and test what was previously resistance as support, which is what we seem to be doing now. Whether or not it holds, I think, is critical. If you see this level not hold and we start to move higher in yields and eventually move above the previous high, I don't even remember what it was on the 10-year, well above 3.20. If we get to, 3.35 or something on the 10-year and we're clearly above the previous high, that really is a strong confirmation sign that the bond bear market is on. The thing is, if we are looking at the beginning of a sell-off that's going to be significant in the equity market, the normal operation would be that yields come down in that situation. Now, I've said before, I think we have the ingredients here for yields to rise even as the stock market is crashing, as both bonds and stocks crash at the same time because of how artificially propped up stocks are. But that's clearly not happening yet. Right now, as we see equities selling off, it's helping bond yields come down. So that normal function is still operating, and we'll just have to keep an eye on it and see what happens.
All right, so our January 19th of 2019 live event in Vancouver is now confirmed. Eric, why don't you give us a quick update?
Patrick, last time we did this, we sold out in something like 10 days. My fear is we're going to sell out in 10 minutes with this list. We've got Alhambra Partners Chief Investment Officer Jeffrey Snyder, MI2 Partners Founder Julian Brigden, JDI Research Founder Juliet DeClercq, GavCal Research Founder Louis Vincent Gav, and Labyrinth Consulting Founder Art Berman. Those are our first 5 speakers. There's still another one that was not able to confirm before we went to air this week, but on the same level as the names that I just gave you: Snyder, Brigden, DeClercq, Gav, Berman. Patrick, we've got an incredible lineup coming, but out of respect for our listeners who are not able to come and don't really want to hear us talk about it while they're waiting to hear the interview with Daniel Lacalle, let's save the rest for people who are interested in the event. We'll cover this at the end of the show, at the end of postgame. We'll give you all of the details. It's really a fantastic program that we have in the works.
Well, thanks for the market update, Eric. This week's feature interview guest is Daniel Lacalle. Eric's interview with Daniel is coming up as Macro Voices continues right here at MacroVoices.com.
And now with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me next on the program is Daniel Lacalle, a professor of global economics and chief economist for Tressis. Daniel, thanks so much for joining us on the program. You and I are taping this interview a day before our listeners will hear it on Wednesday, and just as we began our phone call, we broke to new lows on the S&P 500, below the previous low back on October 11th, I believe it was. So I think the big question on everybody's mind, I'll summarize, is this the big one? Are we really at the point where this longest bull market in history is over and we're about to see either a crash or a new bear market? Or is this just a pullback that needs to play out and maybe we're headed to new all-time highs?
Hi, Eric. Thank you so much for having me on the show. I think that what we're seeing right now is basically that markets are starting to get nervous about a number of catalysts that were not expected to happen. The first one being that bond yields, that the U.S. Treasuries, the 10-year would be rising above what was considered to be sort of a warning zone level. The second one is the yuan weakness and the decision by the Chinese government to try to tackle the alleged trade war through competitive devaluations, which those two catalysts are doing two things. The first one is taking money out of riskier assets, out of emerging markets, out of Eurozone equities, out of US equities, into safer assets. The second one is sending deflationary signals to the rest of the world. So what it basically is sort of a reckoning of an environment in which there was a lot of complacency and a lot of wrong views about a synchronized growth future, reflation trade, buy cyclicals, which ended up being almost a one-sided trade, actually, that was being negative on the U.S. Treasuries, negative on the U.S. dollar, and bullish growth, bullish inflation. And I think that entire sort of mirage is fading right now. Are we entering a massive bear market? I don't think so. And the reason why is because it is very unlikely that we will see monetary policies globally become really hawkish. We're talking about normalization, and actually what we are seeing is a very, very accommodative and very, very loose monetary policy. If you go to the 30-year bond in the United States, it gives you a real yield of about 0.07, no? So that is probably going to continue to keep risky assets in a sort of elevated multiple type of environment. Does that mean higher multiples? Does that mean continuing to inflate the levels further? Not likely. I think that what happens is that the final phase of this extremely loose monetary policy, what it does is what we're seeing in Japan this year, what we're seeing in the Eurozone for the last couple of years, which is that monetary policy maintains multiples. It doesn't increase multiples of both equities and obviously valuations of bonds.
When Jay Powell took over the Fed, he effectively kind of told markets, hey, there's a new sheriff in town and we're not in the business of supporting markets. If this sell-off goes much farther, do you think that he's going to stick to that message and continue with the tightening program that the Fed is under? Or do you think that there's a potential for a reversal in monetary policy in reaction to action in the equity markets?
There is a risk that the Fed gets nervous about a market correction and delays the tightening. But it would be a very big mistake. And the reason why it would be a very big mistake would be that the sort of placebo effect would last very little. Probably it might even not work from the perspective of making different asset classes go further up. And more importantly, would send a very negative signal to the market. If the Fed delays its rate hike plan, what the message that it gives to the market is that they know something that we don't, and that is not a good thing. More importantly, it is a very negative message as well, because if the Fed doesn't build tools into the next cycle now, after losing precious months in the Yellen tenure, in which it could have capitalized on a very bullish market to raise rates. If they don't do it now, it is going to be much worse when the cycle really turns. And that is the risk of stagflation. that we, for example, are living in the UK, or that is not something that we should sort of ignore in, for example, the European Union as growth estimates come down.
Let's focus a little more on the bond market. You mentioned that as one of the catalysts. We've seen, as you mentioned, the 30-year. We've seen the 30-year U.S. Treasury actually move above a 30-year trend line on the 100-month moving average on a monthly closing basis. That's a really long-dated trend line. Is that just a false breakout, or are we really seeing a major sea change in the direction of fixed income here?
It is unlikely that the Federal Reserve will allow that to break further, or that at least they will try to contain it, in my opinion. And the way to contain it actually is to be more hawkish than probably what markets are expecting right now in the short term. I don't think that we're going to be seeing a massive change in duration. What I think is that what we are very likely to see is that as markets get used to seeing downgrades in global growth, while fiscal deficits, fiscal imbalances continue to rise in most economies, and disinflationary pressures start to build in the economy via what I mentioned before, China on one side, and obviously the evidence of overcapacity in some economies, it is probable that we see that 30-year bond, let's say, lose a little bit of steam.
The other thing you mentioned as catalysts for what's going on in the market was the situation in the Eurozone. How would you characterize the overall picture there in terms of both what's happening with ECB policy, but also, the challenges in Italy and so forth? What should we expect next as investors from Europe?
The situation in Europe is one of missed opportunity. The Eurozone had a tremendous opportunity when the ECB launched its QE program for countries to really do their homework and improve their economies, get in shape, take the advantage of low interest rates and high liquidity to improve their debt and their fiscal imbalances. Most of the countries didn't do that. Most of the countries basically took the savings of in interest rate expenses, which amount to more than 1 trillion euro of saved interest expense from the ECB program, spent it all, and now they got used to very low rates and high liquidity, and you're seeing the effects in countries like Italy, but not just Italy. You've seen that the French budget, the Spanish budget, the Portuguese budget, the Slovenian one as well, all of them, the governments are looking at two very dangerous things. One is to increase spending dramatically, and the other one is to try to balance the budget with tax revenue estimates that are, I would call, close to science fiction. So the problem of the Eurozone is then that the ECB has injected 2 trillion euros into the economy. The balance sheet of the ECB is almost double relative to GDP to what the Federal Reserve's balance sheet is. And what ends up happening is that despite that massive stimulus and governments that have had very aggressive budgets. Let's remember that countries like Spain, for example, have increased deficits almost every year, have been deficit spending almost every year since 2008. So what ends up happening is that the level of growth is very poor, that the slowdown is very evident in the economy, and countries have not prepared themselves for the winter, for an environment of rising rates and lower liquidity injections. So what is the problem? The problem is that any investor that is listening to us right now, any of us knows that there is no demand whatsoever for Eurozone sovereign bonds at these yields. And you would have to think of twice, at least, in some of the countries to even start getting the attention of the secondary market. And that is a big problem. And that is a big problem because even if the ECB continues pumping money into the economy, what ends up happening is that it only disguises the risk in sovereign bonds, as we are seeing right now, but moderately. But risk appears in, for example, on the iTraxx. Now, if you see the yields of corporate bonds and obviously in equities, because cost of capital is going up. So the situation in the Eurozone is missed opportunity from the stimulus, too high expectations of a return to growth. We're back to 2009 bad habits from governments and an evident slowdown in the growth of the major economies of the Eurozone.
You spoke about the sovereign debt in the Eurozone. Let's also talk about the corporate debt, and particularly the high yield. Something that's been striking to me is there's actually high yield, junk-rated bonds in Europe that are yielding less than the U.S. 10-year. Something's got to be mispriced there. What's going on? What drives this, and how long can it continue? And is there a risk of a major meltdown in that market?
Well, obviously, what drives this is, I would say, three things. Now, the first, obviously, is the belief that the European Central Bank will keep its very aggressive monetary policy for much longer. So recently we heard Mario Draghi saying that policy has to remain accommodative for as long as it takes. So markets get complacent. The second one, which I think is even more worrying, is a very overly optimistic view of the solvency and liquidity of these issuers. If you look at, for example, the BIS, the Bank of International Settlement analysis, the number of zombie companies in the Eurozone has risen dramatically, has more than doubled in the last 3 years. This means companies that are unable to pay their interest expenses with operating profits, and this with very, very low rates. So solvency ratios and liquidity ratios of issuers have actually not improved in the vast majority of this sector now, of the high yield market. While at the same time, the spread is about 300 basis points over the sovereign, which is nothing. And as you very well said, in real currency adjusted terms, it is slightly higher than the US 10-year. Obviously, you have to make the exchange rate adjustment and an inflation adjustment. But still, you are basically paying these corporates to issue more debt while their ability to repay that debt is worsening. So the risk of a meltdown is very high because, you see, if the European Central Bank, instead of normalizing policy, decides to continue perpetuating this imbalance, what will certainly happen is that sovereign bonds will not reflect the real risk of the economy. But the market is going to react in the areas in which the ECB is not intervening. And this is, for example, high yield as well as equities. So you'll start to see that many of these high yield issuers will have no possibility of, for example, refinancing. You will see much higher spreads. So that is obviously one of the, let's say, of the symptoms that will sort of appear if the ECB decides to, let's say, ignore the real need to build tools for the next cycle and continues to maintain this perverse incentive type of policy.
If we move on to emerging markets, we've seen an outright meltdown in a lot of EM currencies, particularly Argentina, as well as a lot of equity markets. What is the macro driver behind this? What does it mean? And is it signaling something for developed markets that we need to pay attention to?
Well, what happened with emerging markets is, unfortunately, what always happens with emerging markets. I always say to my students that emerging markets don't emerge. And they're the same countries that were emerging markets when I was a kid. So what happens is what always happens is the belief that this time is different. So what happened particularly and accelerating into 2016 and 2017 was this idea that the dollar was going to be weak for longer, that liquidity was going to continue to be flooding emerging markets, that rising fiscal and trade imbalances were not a problem. You had increasing number of countries that were deciding to take more aggressive budget risks. So all these things were sort of taking place as they did before. But on top of that, because of the impact of QE and the massive amount of money that fled into emerging markets, what you had was a very large increase in the foreign exchange denominated debt of emerging markets. On one side, you had tremendous demand from investors. Remember that Argentina issued a 100-year bond. Argentina, a country that in the previous 100 years defaulted at least 8 times, was able to issue a 100-year bond at 8 something yield in dollars. But they had to issue in dollars because investors were very aware of the fact that emerging markets do tend to allow their currencies to depreciate massively. So what these emerging economies ended up doing was to take massive exposure, massive debt in foreign exchange currencies, while at the same time increasing their imbalances. And it exploded, or it's at least erupted, with the countries that had taken a more aggressive monetary policy. Argentina, about 30% increase in money supply every year to finance government spending, etc. Turkey, about 16% rise in money supply for the past years, massive devaluation of the lira already in 2017, etc. So it was sort of a, like this enormous wave that was building, and suddenly it burst. So what we find ourselves with now is a bear market for emerging markets. Bear markets in emerging markets don't end up in a few months. They take at least usually a couple of years. And the average loss in a bear market for emerging markets is about between 55 to 65%. So we're very far away from, let's say, what would be on average, let's say, the bottom. And at the same time, we have in front of us a massive maturity wall of dollar-denominated debt, while foreign exchange reserves are falling. They're not falling dramatically, which is why the markets are not aggressively negative in the last couple of months, but those reserves are falling, and we need to pay a lot of attention to that.
Let's continue around the world to China. Obviously, all American eyes are on President Trump's trade war with China, but I think there's a bigger picture behind the scenes in the sense that, China's credit expansion has just been massive, and a lot of people have been concerned about what happens if that bubble eventually bursts. Where do you think the risks are with China? How should we be thinking about China and the current macro environment?
Every time that I speak with people about China, you have either the ones that say everything is fine because the country still grows 6.5%, which is irrelevant because even the premier said that it was almost a made-up number. And you have the ultra bears that say that China is going to crash in a sort of 2011 Eurozone situation. And my opinion is different. I think that what is more likely to happen in China is a process of gradual move into stagnation, because the entire economy is driven to maintain overcapacity, maintain the imbalances of the system, keep the banks pumping credit into non-economical return type of investments. So the most likely scenario is not a crash. The most likely scenario is not that everything is fine. In my opinion, the most likely scenario is that what we see is actually the economy stagnating, because it sort of feeds into this triple whammy of rising overcapacity, rising debt, and at the same time, a government that has an incentive to keep those imbalances as they are or rising, because the companies that are most at risk, they employ a lot of people. So when the government has as, let's say, as main incentive to keep people working no matter what, it is The idea that it is building white elephants and allowing malinvestment is irrelevant for the policy. And therefore, as it moves, and if you see industrial production, if you see consumption, if you see return on invested capital of the companies in the Shanghai Index, etc., you see that that is where it's heading to. And the idea of the Chinese government is that because it's the only G20 country that has capital controls, it is also the only G20 country in which there are massive barriers to trade because there's no security of intellectual property, there's no legal security because there is no differentiation between government and the judicial system, etc. The government believes that it can export its way out of the problem. Hence the trade war. I mean, which is not a trade war. Either we've been in a trade war since 2001 or we've never been in a trade war. The situation, therefore, is that what we have seen in the last, particularly 10 years, is that governments were sort of accepting those conditions of the Chinese economy that you would not accept in any trading partner: capital controls, lack of legal security, lack of intellectual property security, etc., etc. Countries were accepting that because China grew a lot. But now that China is trying to reduce its problem of overcapacity, exporting its way out of the problem, you see that then, and mostly to the United States, then it's logical that the United States reacts from the perspective of, hey, I'm your biggest customer, so as the biggest customer, I actually have something to say in this debate. My opinion is that now that the Chinese Prime Minister doesn't have any incentive to work to maintain his job, he's got a perennial job, he can have a much more aggressive stance to try to keep those things that they perceive as advantages, and that there are not advantages, like, again, I come back to capital controls. And that is going to be the undoing and the reason why China stagnates, because you cannot have a world reserve currency and an economy that becomes a global leader with capital controls and with lack of legal security.
The price of gold was trading almost in lockstep with the Chinese yuan. If you looked at the chart of gold priced in yuan, it was almost flatline, and then all of a sudden, on October 11th, with no apparent driver or catalyst that I've been able to identify, that correlation broke. Gold moved up dramatically against the dollar, and even on the Tuesday that we're speaking, gold is moving up again, even on a day when the dollar index is holding its own. So it's not the usual inverse relationship. It seems like somehow on October 11th, all the correlations broke down and gold is on its own mission. What's going on here? What's driving this?
Before, what happened was that gold was suffering, also copper, because of the massive amount of gold-backed and copper-backed loans in China. So as the situation in China was becoming more negative, and as you saw margin calls, etc., coming up in equity markets and different other markets, what ended up happening is that those two commodities suffer in tandem as the yuan depreciated. Now, what I find interesting, something happens end of September, beginning of October. And what happens is that what I had been seeing, I always put in my Twitter account, for example, how consensus moves in terms of growth estimates of different economies. So consensus was, I would say, almost unanimously looking at China growing in line or better than expected, and the U.S. as well, while downgrading the rest of the economies, or at least the rest of the major economies. And at the end of September, this changes. At the end of September, you suddenly start to see significant downgrades to the estimates of growth of China, while at the same time, in these first weeks of October, the Chinese government starts to present a large stimulus, tax cuts. So suddenly, I think it's the realization, very similar to what we talked about, different catalysts, no? Is that the market realizes that the rhetoric of China is fine is broken, Because obviously, if China is fine and is going to grow above estimates and is not affected by the trade war, as the media says, and all these things, well, obviously, you don't make a massive tax cut program, and you don't inject 160 billion into the banks, and you don't launch a stimulus package. And I think that that is what changed. And suddenly, gold, which was not working as a sort of recession inflation hedge, suddenly starts working. And I think that what gold is starting to do is to reflect that the tipping point of estimates from, hey, it's just a slight slowdown from the idea of synchronized growth to, hey, this can actually be a much more aggressive slowdown than we originally anticipated. I think it's been, that sort of 3-4 weeks, those 3-4 weeks of different, let's say, data points that sort of led to change the perception of what China was going to do in the next few years.
Okay, Daniel, bringing this all together now that we've been around the world of macro, so to speak, let's talk about the U.S. economy and where it stands. Are we seeing signs as the market is seeming to roll over that maybe we're headed into a recession? Is the U.S. economy about to fall off a cliff, or is it a false alarm?
I think the recession that the market is worried about is quite unlikely. So a dramatic recession, a big sort of 2008, 2001 type of environment. I think that the U.S. economy is rightly perceived as having seen a very long cycle of growth, and that has to change at some point. Now, the problem of this cycle of growth is that I always say to my students, there's 150 million Americans that haven't seen it. So it's been very GDP driven. It's been very official unemployment rate driven, while labor participation rate remained poor, while productivity growth remained very, very weak, while manufacturing jobs were continuing to disappear, all those things. So the reason why I'm more bullish on the United States than maybe the majority of analysts is because that entire part of the economy that did not benefit from the demand side policies of the 2008 to 2016 period is likely to be more than benefited by the strengthening of the US dollar, because unfortunately there are too many people out there still defending a weak dollar in an economy that is so inward looking, that exports so little, and in which consumption depends so much on strengthening of purchasing power. So I think that the economy is going to slow down because the level of growth that we are seeing right now, and we have for the third quarter, 3.3% growth, obviously is not going to grow at 3.3%. What I think is that it does have a lot of catch-up territory, not just in terms of productive capacity utilization. Obviously, we mentioned before that the labor participation rate has to come higher to the levels of countries with similar demographics. The US cannot have almost 8-10 points of difference in terms of labor participation rate with countries with similar demographics. As I said, industrial utilization, purchasing power of consumers. If the government is wise enough, if the US government is wise enough to know that the voters and the citizens and the middle class, the people that actually matter for the next wave of growth, are benefited from a strong dollar, then you can have a stronger period of growth that is not going to be 3%, but it can continue to be in the region of 1.9 to 2% level of growth. And these are important factors because when you speak with many economists, they say, well, labor participation rate is never going to come back. Well, why? Just because you say so? No, it's because it's people that don't want to return to the workforce. Well, that, to be fairly honest, is a very simplistic and completely nonsensical answer. So, as I said, I think that there's an entire part of the country, a massive part of the country, that did not benefit from the period of expansion, that can benefit from supply side measures and drive growth further, particularly if the rest of the world slows down and the dollar strengthens, which ends up benefiting the American consumer and ends up benefiting, obviously, the American corporate sector, which is fundamentally selling to U.S. citizens.
You said a moment ago, if the rest of the world slows down. So let's broaden this discussion out to the global picture. Now, the narrative that's gotten us here, and I'd say narrative, and I'm not sure it's right, is this idea of global synchronized growth. Are we seeing a slowdown in that phenomenon, or was that a false narrative to start with?
It was a completely false narrative. It was the dream of central planners that you could have developed markets growing higher from monetary and fiscal stimulus, and at the same time have emerging markets sort of growing in tandem, slower, but in a more sort of sustainable way. It was a central planner's Excel spreadsheet dream, and it was fake. It was just synchronized debt. What we've seen is massive increase in global debt. Global debt to GDP has gone up to plus 300%. And most countries have gone into large fiscal imbalances while not being the world reserve currency. Because always when we look at fiscal imbalances and we talk about the deficit of the United States, well, the US dollar remains the world reserve currency. It's not the same for Argentina, and it's definitely not the same for Brazil or for Spain or for France. So what we have seen is not synchronized growth, but synchronized debt growth. And when it's synchronized debt growth and the evidence of weakening productivity growth, weakening industrial production, and weakening trade, weakening GDP growth as well becomes, let's say, more evident to the majority of consensus, that's when the sort of mirage ends, because the debt is there, the net financial requirements are rising, but the solvency and liquidity levels are not improving. And that's what we're seeing. But again, I think it's basically the reason why markets are so negative right now is because they were so excessively optimistic at the end of last year. If we had this chat last year, the estimates for 2018 from consensus from investors, from investment banks, from international bodies were simply outrageously optimistic.
Let's touch on commodities next. We've seen a really long trend of deflation in commodities, and then it looked for a little bit like there was a reflation expectation that maybe commodities were going to come back, and now we're seeing them starting to turn back down again, particularly oil. Just as we're speaking, actually, it's gone down quite a bit. What do you see in terms of what are the drivers behind this action in commodities, and where's it headed from here?
I think that pretty much the same, no? Commodities is a reflection of that reflation view and the idea that stronger growth would drive inflationary pressures throughout the world as the slack in the economy was absorbed. So we have to differentiate between metals and obviously energy commodities. Energy commodities, oil in particular, on top of all that, was being bid up by massive supply manipulation. OPEC and the partners that joined the OPEC agreement kept a completely unnecessary lid on production growth when inventories were already coming down to the average of the 5-year level, when demand was already picking up. And so it became, instead of a, let's say, deal with the glut type of a policy, it became a policy of greed. And what happens is that when you get greedy and oil goes to 80, in an environment in which global growth estimates are coming down, global demand growth estimates are also being revised gradually, slowly but surely down, what ends up happening is that you, as OPEC, as the supply manipulators, are actually creating the negative scenario for themselves. And that is, in my view, what has ended up happening is that by keeping too long the supply cuts, they created a short-term bounce on the oil price, a short-term and actually probably too large bounce, and generated the seeds of the undoing of that trade while growth estimates were coming down. This is very similar with copper, by the way, not because of supply manipulation in that case, but because of estimates of industrial growth demand. And that's been, again, added to the Chinese copper-backed debt problem that we mentioned before, another of the issues. So in these commodities, what you're seeing right now is the evidence of the combination of global growth slowdown with the destruction of the narrative of reflation as the driver of the next couple of years. We will have to see, obviously, if what we see right now remains as simply a slowdown in growth estimates to a level that is more normal, or we get into, let's say, a succession or a domino effect of significantly lower estimates of growth.
Well, Daniel, I can't thank you enough for a fantastic interview. Before we go, for our listeners in the retail audience that would like to follow your work, please tell them about where your website is. And for the institutional audience, let them know how they can find out more about the fund you manage at Tressis.
Thank you very much. My website is DLACALLE.com, DanielLacalle.com. For institutional investors, I have a small fund. It's called Adrisa International Opportunities. It invests fundamentally in companies that buy back stock and that don't fall into the trap of low interest rates to increase debt and diversify internationally. And Twitter account, DLacalle_IA, and Facebook, LinkedIn, we're everywhere.
Well, thanks so much for a fantastic interview. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Daniel on the show. You know, from all of the things he shared with us, the one thing that resonated with me was his view on Europe, because I could not agree more. Like, I'm 110% on board with him. The idea that ECB essentially gave all of these countries $1 trillion in interest rate savings through this massive quantitative easing program. And rather than these countries basically using that to kind of fix their problems and sort things out, they just now have gotten addicted to lower interest rates and now are sitting in the situation where once there's rate normalization, all these countries are in a position to actually get into far more trouble than they were in the first place. It may actually end up being a rehash of the debt problems we saw a decade ago. You know, anyway, Daniel's views were just right on the spot in my mind. What did you take away from the interview?
Well, I agree with everything you said except for rehash of a decade ago. I don't think a decade ago is over yet. You know, everybody thinks, or not everybody, most people seem to think, hey, great success. The Fed managed to save the day. We recovered from 2008 and everything's hunky-dory again. I think that there is no free lunch, and the piper has to be paid someday. And the way we've gotten here, Patrick, is the ECB has done it, the Fed has done it, all of the central banks around the world have done it, as Danielle DiMartino Booth and Nomi Prince have told us on this program. We've propped up financial markets with government largesse, and it's worked in the sense of treating the symptoms so that everything just looks great. And I think it's all going to unwind at some point. And I think we're getting closer and closer to that point. So many of Daniel Lacalle's comments really resonated for me, and it just says, okay, we don't know how this unwind is going to happen, but this thing's not over yet, and it's going to be very interesting to see what happens. Maybe right now we're at the cusp of something big. Certainly the last couple days in the equity market have been a real roller coaster ride. We'll see what happens, but one way or another, Patrick, I don't think that we've yet to pay the ultimate payback for the policy largesse that was used in response to the great financial crisis. And I think maybe we're about to. In any event, Patrick, I want to bring in Marin Katusa from Katusa Research at this point, because Marin, not on the last interview we did on MacroVoices, but I think it was 2 interviews ago, had quite a bit to say about Mohammed bin Salman and his role in Saudi Arabia. What we're seeing now in the wake of this Khashoggi murder is there's actually talk about the risk, potentially, of Saudi Arabia sacrificing bin Salman and putting someone else in that role of being the heir apparent to the throne. And meanwhile, we also had, very surprising to me, news where Khalid al-Falih, the Saudi oil minister, basically admitted that Saudi Arabia has no spare production. They're pedaling as fast as they can. They're making as much oil as they can. I would have thought that admission would have been bullish for oil, but it was interpreted by markets as very bearish. Marin, what do you make of all this? You're kind of the voice that had the most to say on Mohammed bin Salman. How does this whole story fit together in your mind?
You know, I know our media wants something drastic to happen. But, you know, Stalin had an incredible quote that really resonates today, and it's going to really piss off a lot of people. But if you think back to where MBS is taking Saudi Arabia, there's going to be no change. It's not like they're going to replace him for this. Was it botched? Definitely. Will we ever find out the truth? Probably not. Is Erdogan playing poker with the Saudis? Definitely, when it comes to releasing the information and tapes and video footage and all that. What is it from a actual royal family, from the monarchy's point of view? This is a growing pain that MBS is going to have to go through, and he's going to have many more instances like this. Now, the question would be, how does America relate to this or accept the screw-up? Well, what's happened in the last year to date, and I see so much data coming about, you know, the Saudis are at full tilt. Well, if you look at Iran and Venezuela, they've each dropped 440,000 barrels, okay, per day of production, year-to-date change. Canada, a lot of people haven't realized, is down 250,000 also. So if you just take Venezuela and Iran from the OPEC side, Saudi have made up for that. Saudis have increased year-to-date by 750,000 barrels. The Russians have increased by about 250,000. Iraq has actually increased by 230. But yet the biggest increase of all is the United States, with a little over 1.1 million barrels a day year-to-date change in national oil production. So what does this mean? Can the Saudis increase more? I do believe they can. Number two, who's benefited the most from all of these, you know, the American sanctions and what's going on in the Middle East? The Saudis. They've increased their market share relative to their peers in the Middle East, more so than anyone else. So will there be a change? Will MBS's days be gone? Not even close. This guy is the future of the Saudi regime, and I'm adamant about it. I've done lots of research, and I think you have to watch what he's doing very closely.
Marin, you nailed the call last time we had you on the program. The oil market was real frothy. You said it was headed lower. You nailed that one. But now that we're down here almost to the 200-day moving average, and we've just perfectly tested on Tuesday afternoon an extended trend line. If you draw a line through those bottoms that we had in June and then in August, we just hit that trend line and we're bouncing. Is it over now, or do you still see lower in store for the oil market?
So let's discuss time frames in the near term, like day to day. I don't focus any of my investment decisions on the day to day, but over the next 6 months, yeah, I do see lower oil prices, and mainly because we see Saudi and Russia and Iraq and the Americans able to pump more oil. And interestingly enough, Iran came out and said, hey, even if the Americans put sanctions on us, it's not like we can't sell to the Chinese. So there's a lot of wild cards here, and if the economy does slow down globally, lower oil price will benefit the Chinese and the emerging markets. So everything's kind of switched where, the last in the '08 crisis is about America importing all this oil. Well, now America's become an exporter, competing with OPEC in certain regions. So the Chinese have a lot more options than they did a decade ago. So over the next 6 to 12 months, I see more pressure on the downside for the price of oil.
Hey, Marin, it's Patrick here. I just wanted to change the topic a little bit onto gold and get you pining in on that. Now, back in August, we saw gold hit about the 1170 level on the downside, and we spent 2 months between basically August and middle of October just consolidating around the 1200 handle on gold. But we really now have seen this trend where the dollar has started to rally in the first instinct, and I know you agree with me on that because of the natural dollar-gold correlation, that we would have thought that gold would have weakened a bit on that news, but instead gold makes this advance higher. We're trading around 1230 at the time of this recording, and yet the dollar is so strong and so is gold. Is there something new going on with the gold market? What's your view here?
There's a few things on the gold market. What's going on? It's getting harder and harder to produce gold, so the costs are increasing when it comes to the actual mine site cost. The biggest producer of gold just merged with one of the larger producers, and it's attracting market attention. So people are starting to realize that, we're in a risk-off market. Things are starting to turn downwards. And look, the U.S. dollar has a lot of things going for it in the right direction, even though a lot of gold bugs hate the U.S. dollar, and so many newsletter writers talk about how the dollar's going down, this and that. I've always disagreed with this concept, because what other currency do you want? I'm a Canadian, and I look how screwed up our country is right now with the pipelines from a federal, provincial, and municipal level, and our debt. Everyone talks about the American debt, but, what's going on in China right now? Well, the Chinese government is propping up their bonds, just like the Japanese were buying their equities. So as screwed up as America is, the rest of the world's even more screwed up, plus interest rates are going up. So I think you're going to see a lot of support for the U.S. dollar. It's going to have more strength relative to other currencies. And for me, if there's a major market sell-off, let's say in the global equities and the slowdown, I see gold actually selling off. And if we have something even remotely close to 2008 or 1987, what I believe is you'll probably see gold touch 1,000 on the downside, maybe even break it to 950. At that point, about 2/3 of the global gold production doesn't make money. And at that point, once you get to that level, there's a base for the actual production cost. Other than that, unless there's a major market sell-off, gold will kind of go sideways here for a while. I don't see anything taking it to 1,400 or 1,500 anytime soon, meaning in the next 6 months, I see gold going sideways. Unless there's a major market sell-off, we'll see about a 20 to 25% drop in the gold price.
Marin, we really appreciate you coming on the program on short notice to give us an update on these topics. But before I let you go, we are about to announce to our listeners our plans on January 19th in Vancouver. We had originally hoped to get you as one of our speakers at that event. We ended up discussing that with you and your team, and we decided it was better just to invite our audience to include in our ticket price access to the VRIC, the Vancouver Resource Investment Conference, which you produce. Please give our listeners, they'll get a chance to hear you speak not on the 19th, but on the 20th and 21st at VRIC. Give us the background. What is VRIC about? What will you and the other speakers be talking about? And who else is going to be speaking there besides yourself, as well as Patrick and myself?
So it's the longest-running conference for investing side. It's been over 30 years. I ventured this with the Cambridge House, who've been running it with the Martin family. Jay now has taken over from his father. Joe Martin started this over 30 years ago. It's the largest. So in January 2018, we had over 8,000 people, and it's the who's who in the industry. I bring out my whole Rolodex of friends, whether it's Ross Beatty, Lucas Lundin, the biggest names in the industry, Rob McEwen. You name them, they're there. And more importantly, I bring out the best companies. So you get to walk around, you get to hear all the different newsletter writers. I create debates. I bring out all the guys like Jim Rickards. We had a great debate with Jim Rickards and Tika Tawari on Bitcoin. Is it, bullish, bearish? And then also I bring out all the different newsletter writers and investment fund managers, and we talk about what to look out for on market scams. on feasibility studies, little mathematical tricks to look out for the resource investor. So it's not just for the retail investor. We have tons of family offices attend. We have massive fund managers show up. There's a whole list. And then for the family offices and the fund managers, we have something called the deal room, where you set up with the conference and you can have one-on-one meetings organized with any of the presenters or management teams at the conference. And otherwise, you can just walk up and go talk to a Ross Beatty who's standing at his booth. It's the only show like it in the world, and that's why I'm producing it, because something that I would go to if I wasn't producing it. So that's kind of like my theme. And every speaker, here's my kind of litmus test. If I'm personally not willing to sit through the talk, they're not invited to my conference with Jay. So that's kind of a litmus test. And I'm probably the world's most ADD person when it comes to investing, and I want action. I don't want nonsense and bullshit about people talking about the same stuff for 30 years. I want to, how do I make money? And that's what the conference is all about.
Well, you've also got the unique qualification of being the only speaker that's ever responded to us by saying, I can't speak at your event, but I'll be happy to invite your entire audience to participate in my event the next day. So we really appreciate that. Listeners, will be giving you the full scoop on how you can get access to VRIC as well as our event on Saturday the 19th in just a few minutes. Marin, thanks so much for joining us on the program. We really appreciate it, and we look forward to seeing you in Vancouver.
You bet. And, I want your audience to know that I rarely do interviews, and I'm doing this with you guys because I like what you're doing, what you and Patrick are doing. So I've reached the point in my career where I only work with people I like and doing things that are kind of like a like-minded crew. Not that we don't challenge each other on ideas or theses on investments or where the markets are going to go, but life's too short to work with people you don't like. And Patrick, I look forward to seeing you in San Fran this weekend.
Thanks, Marin. We'll see you this weekend. Otherwise, Eric, let's move on. The page for our live event out in Vancouver in January is now live. And what's the details? Let our listeners know what's going on.
Well, first of all, it's macrovoices.com/live. Vancouver is going to be our grand event for the foreseeable future. We are still planning to do a U.S. event someday. It's on the back burner for now because things just came together really nicely in Vancouver. I really want to just give a shout out to George Gammon, our volunteer event planner, who's done a fantastic job of working with the Hyatt Vancouver, which is going to host us, and we've got an amazing program. So, as we mentioned earlier in the show, we're going to have Jeff Snyder, Julian Brigden, Juliet DeClercq, Louis Vincent Gav, Art Berman. We're working on one more guest in the same caliber as those others who was unable to confirm, just checking travel schedules, but we expect to have one more. Right now we've got a placeholder where you see my picture on the schedule. We've changed a couple of things. You might be wondering, with all of those incredible speakers, where is there going to be room for Patrick's talk and my talk? The feedback we got from Toronto on Patrick is a couple of people actually told us, hey, I'm a professional options trader. I already know this stuff. Didn't need to hear it. Came for the macro. A larger number of people said, I really, really loved Patrick's content, but it wasn't enough. It wasn't in enough detail. I wanted much more on options. So what we're going to do is have a separate event on Friday. It's an optional add-on to the program. It's $99 extra, and that gives you 9 a.m. to 1 p.m. in a directed class with Patrick that's all about options trading. It will be in the live market. That's the reason it ends at 1 p.m. is that's when the stock market closes on Pacific time. Patrick, give our listeners a sense of what that class is about and what they can expect if they decide and who it's for.
Well, anyone that's watched the presentation we did in MacroVoices live in Toronto, when you put up a PowerPoint and you show a bunch of numbers and strategies, it's cool, but a lot of people really want to actually see the trades really put on and how it looks. All of this knowledge that I want to share with our listeners, and the best way to do it is just to trade live with them. So it's not just going to be options. We're going to be looking at all of the markets, including futures markets and stocks and everything like that. And it's all going to be the process of using a macro top-down screening process. How do you find which sectors you want to be in, what opportunities? How do you size the trade? How do you measure your risk? How do you manage the trade when you're in it? That's something you can't really squeeze into like a 40-minute presentation. So I'm looking forward to those that are interested in trading live with me to join me the day before, and we're going to have a great time.
So just to put the overall program for MacroVoices Live Vancouver together in everyone's mind, it starts with an optional 4-hour trading class with Patrick. That's 9 a.m. to 1 p.m. at the Hyatt in Vancouver on Friday, January 18th. Friday evening, January 18th, is our big reception. We got a lot of feedback from the Toronto event that you wanted more time to network, meet other listeners, as well as meet the speakers socially. So your first opportunity to socialize with other attendees and with our speakers will be our grand reception on Friday evening at the Hyatt. We've got the top floor of the Hyatt with panoramic views of the bay. It's an amazing spot. George really came through for us in terms of the venue. That will be Friday evening. Then all day Saturday, you've got Snyder, Brigden, DeClercq, Louis Vincent Gav, Art Berman, and one more, tentatively me right now, but it's really going to be somebody else as soon as we get confirmation. And I will be participating after those 6 speakers speak. There's going to be another town meeting forum similar to what we did in Toronto. We're going to give it a theme this time, do it a little bit differently. I will be participating in that, so you'll get to hear from me there. And then finally, we're going to add another reception, probably at the Hyatt again, on Saturday night, so that you have a chance after you've heard the speakers to meet them socially, talk with your other attendees about what you heard, as well as talk to the speakers. That will be, again, on Saturday immediately after. So instead of doing the meet and greet as we did it in Toronto in the presentation room, we're going to do it upstairs with the panoramic view at the Hyatt again. We're in the process of finalizing those arrangements. Then on Sunday and Monday, that's the 20th and 21st of January, your MacroVoices Live Pass includes attendance at the Vancouver Resource Investment Conference. Both Patrick and I will be speaking there. Marin Katusa just told you in the previous segment more about what he has planned and what that event is about. That's all included as part of the package. We definitely are really looking forward to seeing you. We're trying to organize this with more social time to spend with our attendees and giving you a chance to meet the speakers and the other attendees. We've got great flights set up from Europe. Juliet DeClercq is coming. If she can, you can too. There's actually some really excellent nonstop flights from all of the European airports. We considered that because we know a lot of you are coming from Europe. And I would ask, though, at this point, as we're speaking on Wednesday afternoon, we don't yet have the link to the Hyatt's booking page. Please wait for the link to appear at macrovoices.com/live before booking your room at the Hyatt. We really want you to get the discount rate that's available. More importantly, frankly, to us than the discount is we need to make sure that everybody who books at the Hyatt is linked to our group code, because we've guaranteed a certain number of rooms and we need to make sure we get credit for them in order for the event to be successful. So we are going to have discounted rooms at the Hyatt. You can stay up to 3 days before or after our event and still get the discounted rate for your entire stay. Stay at the Hyatt for as long as you want, because we get credit for those room nights, and it will help us to produce an even better event next time we come back to the Hyatt. You'll also have the option on the registration page for several people who have emailed me asking how they can get an autographed copy of my new book. We haven't really talked about the book on the program yet. We'll get to it as soon as we can find time. But for those of you who want the autographed copy, you can order it when you sign up for the event, and we'll have it delivered and you can pick it up in Vancouver with my signature on it. Just in the interest, however, of full disclosure, if you don't care about it being signed, it's cheaper and faster to just order it on Amazon. So that option only makes sense if you want the autographed copy. We've got quite a few of our speakers actually are very excited about adding a ski trip to this event. So by all means, bring your skis if you want to go skiing. And unfortunately, it's been a lot of work to organize this. We're not going to do video for this one. So if you want to do this, be sure to sign up. We did the best we could to get the biggest room that we could on short notice. George did an amazing job. But with that list of speakers, I think there is still a very realistic risk that this will sell out. So if you want to come join us in Vancouver, sign up soon. We've got excellent price. It's $299 is the regular price. The early bird is $249. That is good through December 15th. And we've got a super early bird bird at $199 US. That is good through November 15th. So sign up quickly, and you'll both avoid a sellout. Last time we sold out before we even got halfway through the early bird period. So we really hope that we'll have enough room for everybody. We're really looking forward to seeing you in Vancouver.
So, Erik, just to be clear, the link to sign up for the event is already available. It'll be in the Research Roundup email as well on the banner on the homepage. It's just simply the link to book the hotels at the Hyatt that is going to take a few more days to get live, correct?
That is correct. They can register right now for the event at macrovoices.com/live. And if you just come back to that page in a couple of days, you'll find the link there for registering at the Hyatt. It just takes them a couple of days to generate the URL. But on that note, Patrick, we need to wrap the show. So listeners, we need your help as usual. Please let people know about MacroVoices Live. Let them know about MacroVoices in general. Forward your Research Roundup emails. And most importantly, if you haven't done so already, shame, go to macrovoices.com and register your free account. It only takes a couple minutes. It's completely free. We're not going to spam you, and you get our free Research Roundup email, which never contains any advertising or marketing. It's just a compendium of links to all of the best content that we can find on the internet each week. Patrick, tell them what's in this week's Research Roundup.
This week, you're going to find a transcript for today's interview. There's going to be a link to the articles written by Daniel elaborating on many of the narratives he shared with us. There's also a link to the Zero Hedge article picking up on Charlie McElligott's recent views that the market is pulling forward the end-of-cycle timing. And in the spirit of the show also being in Vancouver, there's an interesting article on Vancouver titled The City That Had Too Much Money. Now, you'll find this and so much more in this week's Research Roundup, but that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.